Have you ever wondered why all this massive hype, this huge investment surge around artificial intelligence could actually, well, completely change how we look at the stability of the entire U.S. economy?
It's a really good question
Hmm.
because we aren't just watching a normal tech boom here.
No, it feels like something much bigger, like one of the biggest, most concentrated financial bets in modern history, sort of unfolding right in front of us.
It's definitely an unprecedented gamble.
Hmm.
And the stakes, um, they go way beyond just typical quarterly earnings reports.
So what are we looking at then? What are the core elements?
We're really examining three interconnected risks. There's Wall Street's growing reliance on tech speculation, for one.
Okay.
Then there's the accelerating technology war with China, which is heating up constantly.
Right.
And finally, there's this explicit U.S. geopolitical strategy. The idea is to maintain economic dominance by dominating AI.
And our mission here really is to try and understand this danger zone that's been created by leaning so heavily on just one sector.
Exactly. Because if you take a step back and look at the broader U.S. industrial base, the picture isn't great.
No, it's pretty grim in places. We've seen analyses describing key sectors, shipping, EV manufacturing, clean tech as, well, wastelands might be too strong, but definitely lagging years behind China.
And that's the context.
Yeah.
That's the reality the U.S. is trying to, frankly, outrun. The strategy seems to be double down entirely on AI, make it the single massive engine that can overcome these other industrial weaknesses and keep the U.S. on top globally.
Okay, so let's unpack that core strategy a bit. The goal isn't just better tech, is it? It's about dominance through standardization.
That's a huge part of it, yes.
Yeah.
The U.S. plan seems focused on driving adoption of American AI systems,
Mm-hmm.
American computing hardware, and crucially, American standards all around the world.
So it's geopolitical.
Absolutely. This isn't just building cool software. It's a counter move. Two goals, really. First, lock in American AI exports to allies. And second, directly push back against the influence of Chinese AI models, like their Deep System, which is a major state-backed player, aiming for global reach.
So it's like a new kind of Cold War, but fought with capex, with capital spending.
You could definitely see it that way. And speaking of capital, this is where the hype train really becomes the financial engine for the whole country, almost. The sheer size of the investment is staggering.
Yeah, we've heard about things like Project Stargate. What is that? $500 billion just for AI infrastructure?
That's the plan. $500 billion. And what's really striking is the immediate economic impact this hype seems to be having right now.
You mean the talk from the big banks?
Yes, they're not even whispering anymore. They're openly saying AI investment is the main reason the U.S. economy isn't in a recession.
Okay, give us the hard numbers on that dependency, because they sound pretty wild.
They are. Investment just in the AI sector. It added 1.5% to the entire U.S. gross domestic product
1.5%, just
Yeah.
from AI investment.
in the second quarter of this year. Yeah.
Wow. And compare that to before.
Just 12 months ago, AI's contribution was tiny, less than 0.2%.
So that's a seven-fold increase.
Yeah.
Independence on one single sector in 1 year.
Right. That screams high-risk economic strategy.
And that strategy, it shows up as just monumental, relentless spending capex by the big tech companies.
Huge spending. And maybe just to clarify for everyone, CapEx is the money these companies spend on physical stuff,
Yeah,
data centers, specialized chips, all the infrastructure.
got it.
And the scale is immense. Some might even call it reckless deployment of capital. You've got Meta, Google, Amazon, Microsoft. They're on track to spend well over $400 billion combined on AI CapEx this year and next.
400 billion.
Yes, it's the ultimate field of dreams bet, right? Build the massive computing power first.
And hope the revenue and the demand just show up later.
Pretty much. Build it and they will come.
Okay, let's unpack that. This level of spending, this concentration, it leads us straight into bubble territory, doesn't it? History suggests we need to look very closely at this.
The comparisons to past bubbles are, frankly, a bit unsettling. If you look at standard valuation metrics like price-to-earnings multiples.
The PE ratio, just how much investors pay for each dollar of current profit.
Exactly. U.S. stock PEs are incredibly high right now, hovering around 21.4.
And how does that compare globally?
Well, the rest of the world averages about 15.2. China's even lower, around 13.9. So the U.S. market is priced much, much higher.
And it's concentrated in tech.
Highly concentrated. The top 10 companies in the S&P 500, mostly the big tech players driving AI, are actually more overvalued today than the top companies were back in the 1990s dot-com bubble.
Now that's a statement. More overvalued than the peak in 2000. That peak is legendary for irrationality.
It is. But look at forward PEs, what analysts expect companies to earn. Back at the dot-com peak in 2000, that number was around 25.
Okay.
Today, we're hovering above 27.
So the market is pricing in even more future perfection now than it did for the early internet.
It suggests an expectation of flawless, almost limitless growth that seems
Uh-huh.
very optimistic.
Can we look at a specific example? Does this math feel unsustainable somewhere concrete, like that OpenAI and Oracle partnership?
Yeah, that deal is a perfect illustration of the potential shortfall. OpenAI plans to invest a massive $300 billion in computing power over 5 years.
Okay, so that's $60 billion a year they need to spend.
Right, $60 billion annually. Now, their expected revenue this year, only about $13 billion.
Hold on. Spending $60 billion to make $13 billion. That leaves a $47 billion gap every year.
$47 billion, that has to come from somewhere. Debt, more stock issuance, endless venture capital, all based purely on the promise of massive future earnings.
And how did the market react to that deal?
This is the fascinating part. When that investment plan was announced, Oracle shares jumped 40%.
40%.
Added $300 billion to its market cap, just like that. The market basically cheered a huge debt-fueled spending plan by inflating Oracle's value, even with that massive gap between investment and actual revenue.
It almost sounds like cash just cycling around, boosting valuations without real profit growth underneath.
It can feel like a closed loop sometimes, driven by the narrative. You have NVIDIA selling the essential chips. That justifies the data center builders, Meta, Google, and the others investing heavily.
And they borrow from Wall Street to do it.
Right. They borrow huge sums from the big banks. That spending then feeds back into the GDP numbers, making the economy look strong. It's like a perpetual motion machine, but it's fueled by debt and future hopes.
Which leads us to the scariest part, systemic contagion. This isn't just tech, it's directly tied to Wall Street.
Deeply tied. To fund these giant projects, Meta's planning a data center in Louisiana the size of Manhattan.
Size of Manhattan.
Yeah. To build things like that, they're borrowing staggering amounts. Meta took out $26 billion recently. Vantage, another data center company, borrowed $22 billion.
And the lenders are?
Major U.S. banks.
Yeah.
JP Morgan, among others.
So Wall Street is completely entangled. If this AI bubble pops, those huge loans could go bad.
Catastrophically bad. Banks would face massive losses that could trigger a huge credit crunch, a liquidity crisis.
And that's where the 2008 comparisons come in. We hear analysts saying, this could make 2008 look like a cakewalk.
It's a shocking comparison, but you hear it.
What makes it potentially worse? Is it the scale of the debt, or is it how concentrated the risk is?
I think it's the concentration. In 2008, the risk was spread out across millions of mortgages, right? Bad ones, but spread out.
Yeah, it was diffuse.
Exactly. Here, you're talking about maybe a few dozen enormous loans to a handful of extremely leveraged tech giants. Companies whose valuations are already way ahead of their revenue.
So if the growth story fails for just a couple of key players,
the whole system could seize up almost instantly. The systemic impact could be much faster and deeper than the housing market collapse, potentially.
Okay, so if this whole financial structure relies on endless growth to pay off the debt, that growth has to come from somewhere. Which brings us back to the global competition.
Right. For the U.S. bet to actually pay off, it needs this royal flush outcome, as some call it. They have to win the geopolitical race.
But
Fundamentally, China has to lose the tech race.
it's all or nothing then. Win global demand to justify the valuations.
That seems to be the gamble. And a huge piece of that puzzle is securing the supply chain, which right now basically revolves around one company, NVIDIA.
And we see the political push on that, right? The U.S. government trying to get TSMC to build factories here, create a domestic chip ecosystem.
The intention makes sense.
Okay.
But we also have to be realistic about China's leverage. With current tensions, Beijing can already hurt U.S. chip production just by restricting exports of key materials, like rare earths.
So even if the money is there for the capex,
The physical supply chain is fragile, and that highlights another major hurdle: the industrial limitations within the U.S. itself.
this is what some sources call the unworkable math, right? Even if you have the demand and the chips, can the U.S. actually build out the infrastructure needed? Especially the power grid.
The power grid issue is huge and maybe the most overlooked constraint. For the AI boom alone, the U.S. basically needs to more than double its current electricity generation capacity
Double it. Within how long?
within the next decade or so.
Oh, wow. Can you give us the numbers on that projection?
Sure. Data center power demand is expected to jump from about 170 terawatt hours today to something like 430 TWh by 2035.
That's an enormous increase. That means entirely new power plants, transmission lines, built incredibly fast.
Exactly. And here's the kicker. The cost of building all that new infrastructure is also higher because of the same geopolitical tensions driving the AI race.
How so?
Everything you need, steel, copper wiring components, is maybe 30 to 40% more expensive now because of trade frictions and fragmented supply chains.
So to make the math work, the U.S. needs massive deficit spending and industrial coordination that just isn't really there right now.
It's a huge challenge. The industrial feasibility of this AI bubble might actually be its weakest link. It requires solving multiple massive problems simultaneously.
And all this while facing a really formidable competitor. China's ecosystem is seen as innovative, fast, and very strategically focused. Analysts keep saying they're just nanoseconds behind.
Right. And a key difference might be how they're competing. While the U.S. seems focused on brute force spending, just buying more and more chips.
China's finding workarounds.
It appears so. Chinese tech giants seem to be working smarter, developing innovative ways to get around U.S. sanctions, rather than just relying on getting massive amounts of U.S. hardware.
Is there a concrete example of that efficiency?
Alibaba is a prime one. They announced recently they're cutting their reliance on NVIDIA GPUs by something like 82%.
82%? How?
Through clever software, new pooling systems, without equally optimizing to get more performance out of less hardware. They're running their big AI models much more cheaply and using far less energy.
So China's achieving more with less, while the U.S. is burning potentially $500 billion just trying to stay slightly ahead.
That's the dynamic it sets up. And Beijing is backing this with a very deep, systemic, top-down strategy.
Something the U.S. structure can't easily replicate.
Not in the same way. The Chinese central government is actively merging its tech sector with its industrial sector. They're trying to create this self-sustaining loop for AI supply and demand.
Aiming for total tech self-reliance.
That seems to be the goal. They're positioning AI investment as the answer to all sorts of domestic challenges. Jobs, GDP growth, even income inequality. It's systemic.
So it's like China is trying to solve its industrial capacity issues using AI, while the U.S. is trying to buy AI dominance with financial engineering and just hoping the industrial side can somehow catch up later.
That's a good way to put it. It's a fundamental difference in approach. China's strategy, on paper at least, looks cheaper, more coordinated, and maybe more sustainable long term.
Whereas the U.S. approach, heavily reliant on debt, these sky-high valuations, it feels inherently fragile.
Fragile by design, perhaps.
So this whole analysis really seems to boil down to one critical tension. You have the U.S. economy hyper-financialized, with this growth increasingly perched on this AI hype bubble. And for that bubble not to implode, potentially taking the global financial system with it, we need that royal flush outcome you mentioned. China has to lose the race. The power grid has to get built out quickly and affordably. Revenue somehow has to magically catch up to these astronomical valuations.
It's asking for a lot of things to go perfectly right, all at once. And the whole system is underpinned by enormous debt and deficit spending.
So if this highly leveraged strategy falters, and if China's approach structurally cheaper, backed by a strong industrial base, proves more durable,
then the implications for U.S. global influence could be truly transformative. It challenges the foundations of its economic power projection.
and that really is the core question for the next decade, isn't it? If current U.S. growth leans so heavily on this massive debt-fueled AI gamble, and if the underlying industrial and power math just doesn't quite add up, what does happen to U.S. global standing if this enormous bubble finally pops?
That's the multi-trillion-dollar question. Something for you, the listener, to definitely think about as you watch this all unfold.